Perspectives. We're joined by John Herrmann, Director of U.S. Rate Strategies at Mitsubishi UFJ Securities, and John Allison, Chairman and CEO at Unio Holdings. Gentlemen, John and John, thank you for joining us tonight.
Thank you.
So, John, let's start off with you, John Allison. 2014, what can we expect?
I think we can expect equities to still be the place to be, but with sharp retreats. I think we're going to have trading retreats because, as I was telling you before the show, it's like being on a ship where everybody's on one side of the ship, the equity side, and any little thing, rising interest rates, a foreign policy problem, profits not coming in as the way they should, causes people to run to the other side of the ship. So I think that we're on balance going up, but I think we're going to have some very sharp retreats, and those sharp retreats for people like myself and others like me, we love because those are opportunities.
Any kind of percentage in terms of sharp retreat forecasting?
I look, to me, sharp retreats are 7% to 15%.
Wow, that's pretty significant.
Yeah.
Now, you mentioned interest rates.
Yeah.
And of course, with the Fed, we do expect those to rise, right, John?
Exactly. So what we think is we're going to take sort of a more macro thematic view of stocks and of the interest rate markets. So what we think is going on is we look for the unemployment rate. Last year when we were on the show, we were saying that jobs were going to grow much faster than anyone was thinking, and that would cause the rates to rise and cause the Fed to come into this sort of tapering game. So that was our pitch early on last year and all through the year. So we think this year what we're going to see is something even more meaningful. We look for the unemployment rate to fall very rapidly over the next 2 to 3 years.
How rapidly?
Here's what we're talking about. Currently it's 7%. We think it ends this coming year at 5.9, and that we're testing 5% at the end of 2015 and around 4.4 in mid-2016. So we're looking for unemployment rates to come down much faster than the Fed's expecting. And what that's going to do is it'll catalyze the interest rates to start rising and to go up even more aggressively than what we've seen. But what we've saw when we go back to episodes like this, where we've seen a rising rate environment, the safest place to hide, so to speak, is in equities, undeniably. We saw that in 2004.
So which sector in particular? You've got rising interest rates, according to you.
Yes.
Better job prospects. Which sectors are going to make some money here?
The Fed, we can touch on this as well. The Fed, we think, is going to work very hard and very diligent to manage the progress and the rate at which rates back up. So that's what we think they're going to do. So in this environment, financials could actually do really well in the face of a steeper yield curve. We also think that the CapEx, we were talking about before the show about CapEx. We think CapEx is really in a very good, because business confidence should turn around and get even more emboldened. So we look for CapEx to be very strong. But we also saw strong leadership in CapEx from the aircraft sector. Aircraft is really driving, that entire sector is really driving a big wave in CapEx.
John Allison, you're nodding in agreement?
Yeah, so I am. I mean, it's okay to agree sometimes, because,
it's okay.
because what John Herrmann is saying is that these unexpectedly high interest rates are actually part of what's, I think, going to create these opportunities, these corrections. And I think because of confidence, you're going to have capital spending type companies. I agree with him on that. I think one area that we were talking before the show is healthcare. When people are more prosperous, more confident, they use healthcare. I think employment companies, I mentioned Adecco, which is a company a bit largest in the world in Switzerland. That kind of thing is going to do well.
But what about Obamacare's impact on healthcare?
I think Obamacare is complexity cubed. But out of complexity, there are companies that can make something of it. So some will and some won't. So for example, I think drug companies that have good drugs are actually going to do well with Obamacare because there's going to be more use of them.
Do you think that the Fed tapering is going to lead to an investor confidence withdrawal? If you're playing an ETF, an exchange-traded fund, the S&P, for example, and you're up almost 30%, should you take some money off the table, John Allison?
Yes, I would definitely take money off the table. The question is, what do you do with it?
Right.
Okay. So I know what to do with it. Unfortunately, the problem is if you take money off the table, you got to put it in cash or put it in something else. But I would definitely take some profits.
Okay, my biggest positions at the beginning of last year were Russell 2000, S&P, NASDAQ, and the German DAX. That's where I thought we'd get most growth occurring on a global basis. And I think I'm unwilling to cut. I reduced all of my bond holdings last year in June. And so what I think with yields still rising, an old Henry Kaufman style trade from 1993, 94 was that you would, when you got in these environments, you buried yourself in short-term T-bills or in 2-year Treasury notes and just rode out the cycle. And I think that's that's actually, I think it's too cautious. I think the Fed will be careful managing
The Fed
things.
should be careful, hopefully, managing this. Other than the Fed, what is very quickly your #1 threat to the markets for this year?
I just think, you know, what we'd like to see better, and there's room for upside surprise on this, is Congress and the President have really not been pro-growth and pro-business and pro-finance. And if there's any way that there's a shift in attitude, just slightly more business-friendly, then this economy is really going to go.
Okay, so your question mark is Congress. John Allison, what do you think could be the big headwind, if any, for 2014?
I think the place where people are least expecting things are foreign policy problems. I think there's much more political risk in the world than people believe. I think the U.S. is looking at the U.S., and it's doing very well, but the U.S. is just part of a bigger world. So I think that's one place we're looking at both the economic side of political risk and the actual political side of political risk.
Very quickly, the Shanghai index down over 6% for the year. What's your prospects on China's market?
I think China is doing something historically that's never been done before on a grand scale, which is moving from this export infrastructure market to a domestic and consumption market. I think it's too early to tell how it's going to happen. So I think in China, the issue is a wait-and-see attitude. And I think the Chinese market is down partly because of that uncertainty and wait-and-see attitude.
All right.
Ask me next year.
We're going to give you the last word. Thank you so much. We have John Allison, CEO and Chairman of Unio Holdings, and John Herrmann, Director of U.S. Rate Strategies at Mitsubishi UFJ Securities.